Scott Marlette. How are
Come
you, sir?
on.
Good to see you.
Good to see you.
So next up we have Scott, and Scott is a dear old friend from before this journey with GoodRX, because Scott was an early engineer and product guy at Facebook in the early days. So you've seen the venture-backed rocket ship version, but then we're part of the team that put together GoodRX, which has another one of these amazing stories where, again, I'd love you to tell it, but just kind of that you were able to take an extremely small amount of money and build a hell of a business, right? That really, you had a lot of options around as you grew. So, if you don't mind, for the people here, it'd be great. Do you mind walking through the story of how GoodRx got going and kind of your early capital strategy around it?
Sure. Um, I mean, if you're not familiar with the business, it's essentially prescription price comparison. So kind of like Kayak for prescription drugs. The genesis of the business is, like a lot of founder stories, literally my partner Doug had a prescription and was, going to a pharmacy, and the pharmacist told him it was $200, and he thought that seemed unreasonable, and so he walked across the street and it was $80, the pharmacy across the street. So we had kind of been talking about a bunch of ideas and looked into this, and like every early idea, you kind of second guess yourself and say, nah, there's a reason this exists. Like every idea, we had come up with 100 different business ideas, and everything had been done. There's a reason that you can't get into the market, or whatever our pessimistic view on it. But we kept pushing, because every time we overturned another stone, there wasn't a good answer, and it didn't seem like it worked well. And the system was not transparent, or we couldn't get access to the information. And so we kind of just went down this rabbit hole of pushing on, saying, how can we get access to these prices? How can we present this in a way to consumers that made sense? You've got something that millions and millions of Americans do every month, which is go to the pharmacy to get their prescription. And um, it was a process that seemed incredibly just confusing and opaque. No one knows, simple things like no one knows how to spell the name of the drug that they take. And so it was just sort of iterating on those things in the beginning. And then I think along the way, we found like a way to work with partners within the prescription industry to get access to pricing, to offer discounts to consumers, and to get paid on the transaction. And that sort of journey, was a couple years kind of in the early days of starting the company. We had raised we'd raised about $1.5 million pretty early on. We had a prototype, but it was pretty minimal. And we launched the business at Web 2.0 in 2010, and really kind of like, from there, you have this dream of launching a website, and you put it on the internet and no one shows up. And so it was from there, it was kind of going from zero to the first 1,000 customers, to then the first kind of $1 million in revenue. And as Sam sort of alludes to, we had raised $1.5 million. We had gone through the process of building the site, starting to do things like performance marketing, SEO, build the team, and never raised more money until we did a private equity transaction, kind of buyout in 2015.
So, so
Yeah.
just to ask you, I mean, on this, I mean, like, again, it's interesting because Wade, obviously his shtick, which makes sense, is he's from kind of the outside coming in, hasn't is looking from like kind of the Midwest, kind of looking at Silicon Valley. I mean, you guys are like the ultimate Silicon Valley insiders, right? Like you had been at Facebook, you made plenty of money at Facebook, right? I guess my first question is like, why even raise in the first place, right? Like you clearly could have just bootstrapped this yourself, right? And then how did you think about, I mean, I'm just kind of curious what that early conversations were about, like how to raise money, what capital to take, what not to, et cetera.
Yeah, it's a good question. It's always in hindsight, you're like, oh man, that would have been the perfect setup if we had just put in our own money. We would have had infinite freedom. It would have totally alleviated, all different dynamics between investors and trajectory. Um, it wasn't, I'd like to say it was some super well thought out conversation. I think it was a little more like there's a trajectory of raising money. I think the other thing is we didn't know how much capital we were eventually going to need.
Yeah.
You know, the fact that we didn't raise any more money was not something that we planned to do. It was really just a byproduct of the early growth and sort of access to, we did have access to some debt financing kind of to bridge to profitability. Although at that time, things were kind of going well enough where we were like, well, we'll just put in the money ourselves in order to get to profitability because we had a little bit more line of sight. I think you get good validation from fundraising. And so, you know, the reasons, you know, we always had this thing around PR where our customers were not tech people, right? They weren't, you know, they were, we preferred to have press in USA Today than TechCrunch. And, you know, the reasons, you know, good to, and I'll get back to fundraising in a second. The reasons, you know, the press was good is we could hire people, it could validate the company, we could, you know, it would validate the company for business partners, and that sort of all just helped in the early days. And you know, I think we did have good mentors and investors, and those things I think did help in some ways professionalize the organization. You know, and so I'd say we could have done it on our own. And look, we did finance the initial development of the product, and we did hire people before we had money, and so that was a huge advantage to be able to go out to a fundraising market where, you know, we had a totally working prototype and a fully developed team before we raised $1.
Yep. Yep. So then, like, okay, so you guys raised this kind of early round. I don't think any of your investors expected you to never need money again. Did you expect, like, what was the mentality then? And then when did you have that moment where you're just like, we're just not raising ever again. We can just grow off of what we kill.
We were, you know, so like the company was, well, it's both, I think, like unique time and like unique structure of a company. I mean, there's lots of companies that sort of look like this, but because we kind of quickly got to a growth curve where we were getting lots of organic new customers through SEO. We had kind of this like little bit of like an SEO hole that we filled, that we were able to get really high intent customers for free and kind of dominate that space, on top of getting early marketing channels to work, some of which were traditional, like Google search ads, and some of which were non-traditional, like mailing things to doctors' offices.
Yep.
And once those things were working, we had relatively short payback periods, which was critical to kind of deploying marketing dollars. And you know, we were making back our marketing outlay in 3 months. And you know, so we could recycle the cash. If we spent $1 million, we would immediately get that cash back in 3 months. You know, we had short payment cycles, like cash payment cycles to us. And, you know, we could take that $1 million, spend it. 3 months later, we'd take another $1 million plus the $1 million that we were making on the first group. So in 6 months, we were spending $2 million on marketing. And I think it was mostly this moment where our ability to sort of execute on growing marketing was underpacing the amount of cash that we were able to bring back in. And there was a short period, I mean, I do remember there was a short period of time where you were like, I think we're gonna run out of cash in 6 months, but things are growing really well, so I think it'll be okay. Maybe we'll bridge the gap. We had a sort of really clear line of sight into kind of cash flow positive profitability. And that trajectory, that compounding sort of marketing trajectory, was very clear that we were going to be able to spend millions of dollars a year, you know, tens of millions of dollars a year very quickly. And there were some opportunities to raise money. I mean, you know, in hindsight, these conversations sound sort of silly, right? Where we're in some negotiation to raise money and we didn't really need it. So I think somebody was going to offer to put in $6 million in the company. And we were like, well, if we're really going to do it, we should raise 8. And they were like, it's too much money. And we're like, okay, that's fine. Like, we'll just go on our way and, you know, move on with life. And I think the rest is sort of history. But it's, you know, you kind of are, you think you can compound, I think, like, you know, investment in capital into your business in order to get more return. But ultimately, like, I guess I'd say the key turning point was just inability to deploy capital efficiently or as quickly as we wanted to. And I think it's somewhat unique in our business in that it's like, it's a thin layer, right? You know, we two-sided marketplace with very, you know, with software in between and no physical services. And so I think that helped the process.
Do you think, was there ever a moment though where you're just like, this thing is crushing it? Like, let's be more ambitious. Let's raise a ton of money and buy some pharmacies or whatever. You know what I mean? Like, do kind of the let's you like, I don't know. What did that ever come up, or were you guys like, we're a pure play, we know what we are, we're growing as quickly as we can based on kind of the paybacks we get, et cetera?
Well, I think partially we were outside of the Silicon Valley fundraising flow by being in Los Angeles. And so there was a little less impetus to, I feel like there's this, a little bit of this thing in VC world, not to throw Sam under the bus, but there's a little
Oh,
bit of this
it's
VC
fine.
world, which is like, we need to deploy capital, right? And so they want you to take that next check.
That's not throwing me under the bus. This has been my
Yeah.
whole like this is my talk track against multi-stage firms.
So we didn't have that. Like we were out of band of that. And it's funny, the only moment I ever really thought about this was after we had brought in the private equity investors and we had sort of run this investment banking process. I was like, man, we spent 6 months telling everybody how amazing our business is. Like, why don't we go raise $100 million from some late stage VC and go blow this thing out of the water? I still, look, I still think you could, analyze the past, but it wasn't there. It wasn't obvious that we could do that, and it wasn't obvious that more capital helped. I mean, we looked at even really early on. We looked at pharmacy delivery. We looked at starting our own pharmacies, doing things like a non-dispensing pharmacy where you send us the prescription, we send it to somebody else. I mean, we looked into all of these things, and they were all really, really, really hard. And it wasn't clear that capital fixed that problem. And I think you see that in a lot of the pharmacy startups now, where it's just really hard to work in the system and it's really hard to get enough traction to get to scale. And
Yeah.
I think we liked our easy business and we thought that there was a ton of runway there. And it was incredibly profitable. And so I think
Yeah. So
we
I mean, because
yeah,
I like to that point, I mean, like you guys then did. I mean, it's kind of an amazing timeline, right? Because like within a few years, you did like a pretty major like secondary transaction, your first of I think a few to some PE folks, and took some off the table, right? Personally, how did you think about that? Was it just like, I mean, you guys all had money anyway, right? Like I don't know. I'm kind of curious what the calculus was on that. As you guys were thinking about doing those secondaries.
we were people who like we never thought it was going to work. Like we're perpetually like looking at the whole the risks in the business and maybe this is going to fall apart. And that continued from $1 million in revenue to $5 million in revenue to $50 million in revenue to $500 million in revenue, right? Like we're always kind of looking at the places in the business where we need to sort of fix and improve and de-risk. And I think in some ways that did like pervade. I also just think we never, we owned most of the business. It was worth over $300 million. We thought that that was incredibly successful. And, I think this was in some ways like pre-unicorn, mentality, where like this is the benchmark. And I think it was more than we had expected. And, we were really happy with that. And I think we're obviously incredibly happy with the long-term trajectory.
Yeah.
And I would say it's not that we wouldn't have gotten there. I think doing the secondary transaction and bringing other investors in, I mean, to your point about even just raising money early on, I would say bringing in private equity investors created a huge forcing function in order to operate the business in a much more rigorous way, right? The board meeting was me and my two founders going to breakfast, and then all of a sudden it's, okay, we need real financial reporting with real analysis, with models that we can stand behind. And, we had really great sophisticated marketing models and we would, our mentality was a little more like, if we didn't spend it in the business, we would rather just take it home, and that was kind of how we thought about all the dollars deployed. And so it kept it sort of rigorous, at least enough for our own purposes. But it was, you can't sit across the table from somebody and say, yeah, I just have a feeling that this is the right way to spend the money or how we're going to hit it. When they've
Totally.
invested now hundreds of millions of dollars in your business, they want to know that you're doing some financial analysis.
Fair enough. So that's the, I mean, I think a good, the right type of good rigor. I'm kind of curious, like, we talked to Wade about, like, talk to me about competitors and then team. Like, how did you think about, like, obviously you guys start getting super successful. I have to imagine, although I don't know the market super well, other people noticed and then started trying to like come after you in various ways. Like, how did you think about that? And kind of, was there any scramble around that, or we need to go faster to lock things up, or was that just never a concern?
It just didn't really exist in our market. I mean, there is a single large competitor in the kind of like prescription discount space that we were, you know, cognizant of and constantly kind of, you know, not we were competing in certain ways, but our business, their business was really traditional,
Yeah.
kind of direct mail marketing, and ours was mostly online. And they like we sort of moved into their business, they kind of moved into our business. It made acquisition expensive in certain ways, but the market is huge, right? You got probably now $5 to $6 billion a year in prescription drugs, and to this day, it's small, or sorry, probably
A lot more than that.
or maybe 400 billion. I don't know. Sorry, now
It's
I'm
a lot
like,
more than five. Point
sorry,
take.
I think it's like 400 billion or something like that. It was like so 400 billion. So we were like 1 billion or something of the
Yeah.
total market, right? Even now. And so it's one of these things where I'm like, the market is huge. Like we often thought, like, could we put billboards up that just said, go online and look up your prescription prices? Because that mentality was something that we were fighting against.
Yep.
Um, the Yeah, I mean, it just like it wasn't a go fast, like we had to do this. It was more like a be smart with the money, grow intelligently, don't waste money, and sort of be diligent. And then you asked about team,
Yeah.
did we need to bring on more people?
Well, no, like, did you bring them on? How did the team think about equity compensation? Were there people that like you wanted that you didn't get? You know what I mean? Like, how did you think about that? Or was it kind of like way where you guys were kind of out of the prime Silicon Valley mentality, so it was less of relevant?
Early on or later on, do you
Well,
think?
both. I don't know. What's the give me
Yeah,
the
I mean,
story?
early, I heard kind of Wade talk about this too. We early on, we were really efficient with capital. We hired a designer kind of part-time that did the work from anywhere thing before anybody else did. Like he would spend 6 weeks in Barcelona and then Tulum and then Buenos Aires. And it was like, I don't know, he was cheap because he was a nomad and he did good work, and, it was fine. I think we also were like, we could do a lot of the initial technical work and technical
Yes.
oversight. So I think like between I was a little bit more technical, but also had product development experience. One of my partner, Doug, had more kind of product management, product development experience. Trevor did a lot more of the kind of traditional COO type roles, HR, compliance, um, business development things. And I think having those skill sets at the top level and just bifurcating the roles really helped be super efficient. I mean, we had, I think, a developer and a part-time designer, and we had a fully functioning website.
Yeah.
And that, was it just like people were not the problem. Ultimately, building out a marketing organization, building out a really functioning kind of internal finance organization, and tech long term, I think was important. But again, we had cash. So cash, like while it's really important to give people equity, I think ultimately cash works pretty well too. And you're
And I
able to.
mean, did you? I mean, you obviously share what you do want to versus not, but like, how did like, did you have people coming in being like, I don't understand how to value my equity, right? Or was that like not as much of an issue?
It wasn't so much of an issue, but we were also just like on a good trajectory. And I
Yeah.
think this, to your, like, there's, look, you and I used to talk about this in venture funding, right? There's like a cadence in your lane, right? If you raise a series seed and you raise a series A and you raise a series B at sort of normal valuations with normal amounts of capital, you're like in the lane. And so everyone understands like kind of how to value you. As soon as you get out of that lane, you raise from a non-traditional VC or a corporate VC or something else that changes the calculus, it's harder to get back in the lane.
Yeah.
We at least like, while we didn't raise a lot of money, we were still like in the lane. Like
Yeah.
we had raised from normal VC funds for a seed round and angel investors. And then, even let's see, the private equity transaction was 2015. It was like that was, still like a normal thing. Like, hey, we have growth investors that want to put in a lot of capital. And then the idea is, well, long term, they want their capital back, just like most late stage VCs do. And so we're going to continue to grow. And so I think people kind of knew how to do that. I mean, there is that interim period, but we were still like in a such high growth trajectory. And I would say we also just like our most successful employees, were relatively junior employees initially. Like I don't think we were that concerned. And again, maybe this is because of our own experience. Like we didn't necessarily need to go out and hire some rock star executive in order
Yeah.
to, run
But
some division of the company.
totally. And I think that kind of like is a thing I think, is a theme of like, I'm kind of knowing a little bit of the stories that are coming up too, which is like when you have super technical teams or teams that can just do whatever the business is, can execute it themselves, you're not bottlenecked by ever needing a specific amount of capital, but you're also not necessarily not like by needing a specific person, right? And I think that kind of leverage definitely can change like how the cadence at which you approach things. Like it becomes less of a forcing function to do unnatural things.
We would do like, we would do the job ourselves. It's like I did, like I'd buy search ads, and I was like, I don't know how to buy search ads. It's like, let's just go buy them. And then we'd be like, okay, well, this is like kind of working, and we'd hire somebody, and instantly they would make it 2 to 3 times better, right? And so it was very clear, like,
That's funny. I was just easily make it worse, but that's
oh
funny.
no, it was like they would make it better because it's like I would be like, plugging away, and I'm like, I don't know about search ads, but we're making money, and they would come in, and it turns out there's like a little bit of rigor you can apply to this, and really do a good job. I mean, although similar, and then you get into later things where I was buying TV advertising for a couple of years, and produced a TV commercial, and like, could it have been better? Sure. Like, did it work? Absolutely. Like, and then when someone tried to sell us something or a service or come in and tell us something, like, you could know when they were bullshitting you because you did
Because
the
you did it.
job.
Yeah.
You know how hard it is. I mean, there's this
Yeah.
common thing, which is people like to sort of create, I mean, like the insidious thing is in huge companies, like they create sort of fiefdoms. But in smaller companies, they create roles where they carve out something for themselves and they'd like want to own the thing. And owning the thing may not be a job, right? It may just be a task that somebody else in the company can do. And so I think we were really careful about, making sure that we brought people in that, I mean, look, bring people in that are super smart, but bring people in that are like, accomplishing the task and the goal instead of creating an organization. We never hired somebody to fill a seat. It was, we hired somebody to do a very particular job.
Yes. Yeah, I think that's really great advice and great insight because I think you end up with thinking about like what the mentality is when you're founding these types of things. Like you have to love the problem or like have a really strong thesis about the problem you're after, and then both be like able to do the work to deliver, but then flexible enough and generalist enough that like as the company evolves and the needs evolves, it all starts from like, yes, Scott, you can produce the TV commercial, and that either it works or even if it doesn't work in theory, you've done it so you understand when people are bullshitting you, right? So you don't end up with a bunch of extra capital and then extra people and extra superstructure that you don't need because like you know enough about what needs to be done that you don't just like say I don't know how to do this, whatever you say goes, right? Which I think is an interesting point. Interesting. Cool. So I guess like you guys are I guess the last thing I'll probe on in a few minutes and then we can have a question or two is like you guys went public. Um, Obviously I understand part of the story was you guys had obviously these secondary investors or people and like they need to get their money out somehow, et cetera. I'm kind of curious, like as founders, how you thought about that transition and like when the timing was right on that and things like that.
Yeah, I'm not the best person to ask because I wasn't there to deal with
Fair
it, I
enough.
guess, or have to deal with it. I mean, speaking totally from the outside, I think you're right. I mean, look, we had ultimately, Silver Lake was a late stage investor. Um, I think there's a lot of momentum, but I think there's also a lot of, I think similar to the earlier private equity rounds, I think there's an amount of rigor to become a public company. I think that is important. I mean, look, there's obviously a lot of regulatory things, but the ability to sort of organize the company, predict the finances and the outcomes of your work, and then go back. I mean, you could argue, we're not doing this well, but you could, just that process, I think, is valuable within the business. And I see the feedback loop in that. And so, while a lot of people would say, oh, you're just jumping through hoops to present something to the public markets, I still think that there's an element of like, this is ultimately valuable to the company.
Yeah.
And I think there is good, kind of it's a good checkpoint goal for, look, yourself, your investors, your
Yep.
employees, and you see all of these companies that, really wanted to stay private for a long time. You continually get into creative solutions to value equity, do buybacks, create secondary markets, and that's fine in certain types of markets. It becomes totally intractable in other markets.
Yeah.
And look, do you insulate yourself from the crazy tech downswings? Of course. But I think in some ways it's a trade-off from one problem to another within the market.
Fair enough. Caroline, do you have any good questions for Scott we should highlight?
Yeah, so we have a few, but one is 1% points to Rippling and Ramp as sort of contra examples of companies that had very connected, successful second-time founders. How do you think about these larger but very targeted raises?
I'm not familiar with those stories, but how do I think about the late stage raises?
Well, let me try to phrase the question a little bit differently, Scott, which is like Rippling, I think is a good example. Parker started it, obviously. It's a revenge company, right? But a very successful one, right? And they raised a boatload of capital and worked in private for a year on a market they knew and just like have gone really aggressively and hard in the other direction, right? They built what looks like an amazing business, right? But they've obviously gone super capital heavy. I guess maybe the question unwinding is like go back to the beginning when you guys are thinking about what to do, right? It was a different era. Capital was not as available. Like it was a different setup. But did you ever have that, like, should we like pick a problem? We're well known. We've been successful. Go do a mega round and like, do the hardcore version of capital heavy startup?
I mean, yes, right? You could say, okay, let's go raise $100 million and go create our own pharmacy or PBM or something like that, right? Like do something super, disruptive within the business. I would say yes, we consider that. I think after now being involved in lots of startups and seeing this over and over again, I think some of it is it just didn't like fit our personalities and our type. And look, I've been involved in other startups where I'm an investor in the startup, and I look at that founder and I'm like, you have got to go raise $100 million in order to blow this market out. You're totally leaving money on the table, and I'm the one saying this to them, and they're like, "Meh, I don't know. I'll raise $10 million. I think I'll kind of like incrementally improve." I think you kind of got to like do what suits your own style and business,
Yeah.
and look, those raises are totally like zero or ones, and those businesses will, most of them will go out of business. Most of them will blow a lot of cap. I mean, you were talking about the Uber and Lyft examples, and like more likely than not, I think if you looked at the analysis of these companies that are raising hundreds of millions of dollars to go dominate a market, they're actually just blowing capital in the process of getting there. And we felt like we could spend tons of time and exploratory capital looking at the different markets and probing different things. It turns out that most businesses only do one thing correct. And it's like even Google, it's like Google has search ads, and then now they have YouTube, and it's like they've got a couple things that are good, and you explore a bunch of different things. You might look, they're on a different scale, they can deploy billions of dollars and try something out. And so I think that's a little bit more how we thought about it. I think we weren't going to like reorient the entire business in order to go raise a bunch of money and do something different. But look, that being said, I still think it's still a great startup strategy. I think if you can do it and you want to do it, I think you should, go and do that. And I think that there are plenty of stories where people have successfully gone into markets, and it does take that. I just in some of these traditional businesses too, particularly in healthcare, I think in tech we underestimate how big those businesses are. Like if you look at Caremark, the PBM, right? It's like they bought CVS, right? It's like these healthcare companies are merging multi tens of billions of dollars of mergers into behemoths, and your $100 million isn't going to matter. I think in that scenario, it's like it has to be the right execution and the right plan, and I think we just didn't necessarily see the path.
Yeah, and I think the other thing is that like I just call out, in closing, and I appreciate your time, Scott. Is like you mentioned a few times just like being true to who you are and like the type of business you want to build. I think the thing is like it's not that there aren't opportunities to go try to quote unquote dominate a market and deploy a bunch of capital, but that style of building is extremely different, right? And I think there's a obviously like understanding your DNA, what you want to build, kind of the risk reward profile you want, and then matching capital to that versus just like shoveling capital because there's capital to shovel, right?
Yeah.
Is I think a really cool lesson. And it's cool to see again, like Wade, I like his kind of mentality of like, well, we were just coming from the outside and this is what we had seen be successful and we liked it. I like, you obviously are coming exactly from the inside and we're still like, yeah, I'm gonna be in LA and we're gonna build an incredible business in a capital light manner. So yeah.
Fun.
Scott, thanks for joining. Appreciate it. It's good to see you.
Thanks, Sam. Good to see you.